It sounds, yeah, I had not looked at that.
I wouldn't think the maximum Sharpe ratio portfolio in 2010 would be all bonds. I just don't see why that would be the case.
Yeah, especially for 3 months, yeah. Okay, so here goes the question, and this is an interesting chart to try and read. The question here is, okay, should I look back 3 months, 6 months, or 12 months? And the other question that they wanted to answer, remember, this is UBS. They're actually going out and they're trading all this stuff. So they are worried about trading costs. We might not be so worried about trading costs as they are, okay? But one of the things they wanted to do was, should I do 3 months or 12 months? Well, a 3-month look back every month is 14.9, 13.6, 13.5. So basically, purely on CAGR, 3 months is better, okay? But neither one of these, 6 months or 12 months, is that bad, right? You lose 1.3%. I don't know whether that's good or bad in your view of the world. Now the next thing they did is they said, all right, let's suppose that instead of trading every month, I'm only going to trade on those months when a big chunk, a quote, big chunk to be defined, of my portfolio swings around. So if I had a month where I changed 3% of the money in my portfolio, I'm not going to rebalance. I'm not going to do any trades. That's the vertical column. So that's 20%, 40%, 50%, etc. That's how much of your portfolio. You do the calculations. That's how much of your portfolio has to change before they will actually go out and trade. Okay? And what they come up with, and I'll just pick on 3 months, is if you need to change 20% of your portfolio, that is, you do 89% of the trades. I.e., instead of doing 100 monthly trades, you do 89 monthly trades. Okay? At 50%, you're at 46%. I.e., if you say half my portfolio has to change in terms of dollars before I make a trade, that will eliminate half the trades you have to make. Okay? Or actually a little more than half. Okay? So that's the way to read this chart. Okay? Now, for whatever reason, they decided, well, I'm going to pick 6 months and I'm going to pick 50% and I get 14.1 CAGR and I only have to do 1/4 of the trades. That's where they ended up. I'm a little loosey-goosey about that simply because kind of looks like they picked a local peak, okay? But this is what they say they did. Personally, from my viewpoint, and again, I think about the Faber 5 or the Faber 10 assets, I think for the most part for us, it doesn't cost us that much to trade, right? And so this sort of idea is interesting, but I don't think we have as big of cost of trading necessarily as they do. Now, here's that eye chart over here of asset classes and where you're switching. Well, if you pick 50%, 6 months, turns into that. You eliminate 3/4 of the trades. And now suddenly it looks like this. And it's still bonds, that's what he said. Okay, it's still bonds during, I'll call it second half of 2009, beginning of 2010, which looks really weird. But it may just be the Sharpe, i.e. the volatility.
How did the risk change?
Pardon?
Did they give any information about how the risk changed?
No, they did not. The only thing they gave is a CAGR measurement. Okay. So that's it on maximum Sharpe. Okay. See, one of the things that, for me, this is very interesting in, is this is the sort of thing we do. Historically, we've used some sort of gain over some sort of period. You might use Fund X, you might use 10-month, you might use 3-month gain to kind of rank assets, so it was truly momentum. And Sharpe brings up the issue of volatility, okay? So that's pretty nice. Now, here's a paper that came out this year. In fact, it was a couple months ago. I think it was July, okay? Here's all this stuff, you know, MinVar, etc., all the same portfolios. Right here, that's maximum Sharpe. This is what they call Sharpe Parity. Now, what is Sharpe Parity? It's a lot like, it's somewhat similar to risk parity, okay? In terms of now, instead of doing all this stuff about where are you on the efficient frontier and getting the absolute best Sharpe ratio, you just figure out the Sharpe ratios for your assets. You got a higher Sharpe, you make more money. And that's how you weight it, okay? You're done, okay? Now, I assume, again, when you get into 2008, 2009, they probably go back to the MinVar portfolio again, okay? But that's what Sharpe Parity is. It's a lot simpler than, quote, maximum Sharpe.
So how do you determine the weight?
The weights are, let's suppose I've got a Sharpe of 10, and a Sharpe of 5, and a Sharpe of 5, okay? 10 gets 10 units, 5 units, 5 units. So it's strictly momentum, it's gain, volatility adjusted gain. That's all you're doing, okay? Well, again, the minute you get into negative Sharpes, and they don't talk in this paper about what they do with negative Sharpes. I think they do the same thing that they did in the earlier papers, okay? But this is really easy to compute, okay? I mean, this is, and it's sort of, it has inherent, some degree of inherent logical attraction, okay? Of, oh boy, you know, I got a better Sharpe, I put more money into it. All right. Here are some statistics in terms of drawdown. Okay, so MinVar, for example, it's now a different time period, so it had a 15% drawdown. The Sharpe weighted had a 20. Okay, so you pay more for that gain. However, one of the things they talk about is when you have a deep dive with a MinVar type portfolio, simply because you don't make a lot of money, it takes you a long time to recover. So they talked about recovery times here, okay? And guess what? With max Sharpe, because you tend to make a lot of money, okay? You tend to have a lot of gain, maybe is a better way to put it. Your Sharpe weighted has a better recovery time, okay? For those of you, you know, I read about this originally and it was called flat time, okay? In terms of flat time being on a drawdown curve when you get to zero. How long is that time period? And here, 352 days, and I'm not sure whether that's trading days. I'm guessing it's trading days. Now, one of the reasons they're very interested in all this, the MinVar portfolio and risk parity does great in a falling rate environment. Why? In general, you know, MinVar throws you into bonds, and bonds are going, interest rates are going down, bonds are going up, life is good, okay? What happens when, in fact, you've got a flat or maybe rising rate environment? MinVar might not look that good, okay? Because now you're going to get a double whammy, or you could get a double whammy. And what they point out on this slide over here is back in 79 and 80, they're comparing, and there's, sorry, the colors here are horrible, but effectively risk parity lost 22% because effectively you had a very quick change in interest rates, and you got slammed if you were heavy into risk parity because you were moving into bonds and bonds fell. Okay, so now, why is this important? If you think that we might be in a rising rate environment, MinVar might not want to be the algorithm you use. That's one of the things that they were pitching in this paper. Okay. Now, in case you wonder, this couldn't possibly happen. This is 2000, let's see, it's 2000, let's see, January 3rd, 2013 to January 3rd, 2014. That right there is our friend the SPY, actually the SPX. And this right here is a fund, AQRIX, which is a risk parity fund. Okay? See that small little dip? Remember when everybody got real excited that, we're going to end QE and so on and so forth, and interest rates spiked and all that? That's what happens to risk parity. So this isn't theoretical in that sense. Okay. So, and just as he said, it took, the flat time or the drawdown curve, you hit a peak here, it took them on the order of a year to recover from that drawdown. Okay, because risk parity doesn't make a lot of money very quickly.
That's one example.
That's one example. Okay. For those of you who like correlations, and I don't know anybody who like correlations, this just showed, and you can certainly argue about rolling 3-month correlations, but effectively that bonds became correlated to stocks, positively correlated, negative correlated, then positive, then went back to negative. All right. So with that, again, I think the key things from my viewpoint, and the reason I spent some of your time tonight on this, is at least Sharpe Parity seems like it might be an interesting approach to weighting assets. Notice nowhere in here did we do any volatility adjustment. Nowhere in here did we do any timing. We just changed the weights of the assets without a pure quote-unquote timing signal. Number two, if you believe it, okay, Sharpe Parity probably gives you a pretty good gain versus, for example, things like min-var and equal weight and so on. And then on top of that, if you believe we're in a flat to rising rate environment and strange things may happen when the Fed actually ends QE and starts doing their first rate hikes, could be min-var is not the place to be. Now, part of the problem here is, as I said, the papers aren't well written. There isn't a lot of data here. The time period here is relatively short. Okay? They avoided the 2002 to 2003 bear market. So we got one bear market. In some cases, an anomalous bear market. Okay? So I'm a little loosey-goosey on that. But some of like the favor 5 and favor 10 assets, you can run that easily back to 1990, okay, with using mutual funds and so on, and get an idea of, well, how would this have worked in the real world, okay? And our friend John, unfortunately, raised his hand, okay? I'm going to give John the right to back out. Yes, ma'am.
So are you going to set up, is it too soon for you to set up a tracking portfolio?
Actually, I was thinking about, because it's so simple to compute most of the time, I was thinking about setting up a tracking portfolio with like the favor 5 assets and just see how does it work.
Well, first you have to figure out what they did.
Well,
I mean, it's not clear what they did.
It's not clear what they did. In their defense, you do have the language issue. And there are a lot of statements inside the paper, the equivalent of, well, go read this bulletin and that bulletin and so on. So there may be more data out there. And to also be fair to them, they also said, well, hell, give me a call. That's effectively what they said in a couple of them.
French is really going to work out very well.
Yeah. Hey, absolutely. Okay. Our friend Jean-Marc is going to get a new job. All right. As a translator. All right.
Send them over there personally.
No. So with that, any other questions? Because we're about to shift gears into John's stuff. Yes, sir.
So using that, would the standard deviation be computed on a 3-month basis then?
Yes. Again, as far as I can tell, everything's computed on a 3-month basis. So, and I believe, oh, just to be clear, I believe they use daily returns. So this is computed off of daily variation, okay? Yes, sir.
So when you look at the benchmark, like, half of the equity is in the U.S., and that's really reflective of as an MSCI all market cap. And so when you weight using the Sharpe, the allocation could be very different from
Absolutely. It's wildly
the
different.
benchmark. And U.S. may be quite a small portion.
U.S. may be nothing. U.S. could be 80%. Okay, so it's wildly different. Okay, and that was, those funny peaky type charts. That was the whole purpose. It wanders all over the place. Okay. Yes, sir.
And we found a source for 3 months standard deviation.
No, what I do is just compute it. So the way my default way of doing this is I'll take either the Faber 5 or the Faber 10, and I'm going to download the ETFs, okay, from Yahoo or Fast Track, and then I'll just compute it myself. Okay, the numbers here, the computation is trivial. Okay, that's what originally got me going towards Sharpe Parity, and then I went backwards into maximum Sharpe and CAP-M and all sorts of stuff. So, anything else? If not, I'm going to hand things over to my buddy John here.